I believe that Jack Bogle has done more for American investors than anyone else associated with Wall Street or the investment process because, along with several others, he developed the concept of the index fund. He wasn't the only one to think of it, though. He spearheaded its implementation and advocacy. Today, trillions of dollars are invested in low-cost index funds, ensuring that those investors will live better lives, retire with greater security, and leave more money for their children to inherit. Though he has also identified a common mistake that many investors make when purchasing and holding Vanguard funds. Have you ever heard of having too much of a good thing? Well, that's precisely what we're talking about today in this video, where we'll learn about the mistake Buffett warns us about and how to avoid it. Warren Buffett admires the simplicity and effectiveness of Vanguard funds, including their ETFs founded by Jack Bogle. Personally, I don't diversify, and we're also tackling some important issues. Why do investors find ETFs, particularly Vanguard's, so appealing? What is the secret to investing in ETFs that makes money? How much can you actually expect to make? And lastly, how can you achieve the ideal balance in your ETF investments to guarantee long-term success? Regardless of your level of experience, you should steer clear of this typical error to maintain a robust portfolio. We explain down Buffett's beliefs, propose certain Vanguard ETFs he advocates, and give instances from history and current trends to guide your investment plan. Let's get started by examining why ETFs, particularly those offered by Vanguard, have drawn attention from investors throughout the world. Exchange-traded funds, or ETFs, are popular stock market investments that resemble baskets of stocks or bonds that may be bought and sold because they are a cost-effective option, because to their lower costs than traditional mutual funds, and because they provide an easy way to invest in multiple firms at once, spreading out your risk. However, as Warren Buffett frequently emphasizes, selecting the appropriate Vanguard ETF is more important than simply picking any ETF. ETFs are especially alluring since they are made to mimic the performance of a certain index, such as the S&P 500, allowing you to participate in the market with only one investment. This strategy fits with Buffett's belief that it is better to wager on the market's overall growth over time than on picking specific winners. Like stocks, exchange-traded funds, ETFs, offer unparalleled flexibility in terms of buying and selling at any moment during the trading day. This allows you greater influence over the price of your investment. What's more, the company's dividends these ETFs immediately reinvest them, utilizing the power of compounding to increase your potential gains. While ETFs have many benefits, not all of them are made equal. Some may concentrate on industries or geographical areas that do not meet Buffett's standards for a sound long-term investment. For this reason, Buffett stresses the significance of making informed decisions and emphasizing ETFs that, to put it simply, offer broad market exposure and are supported by a long-term growth philosophy. When it comes to investing, ETFs are like a multi-tool for investors. They are efficient, adaptable, and useful for creating a diversified portfolio. However, as Buffett would remind us, the secret to success is to use this tool intelligently, putting an emphasis on quality and long-term development potential. Warren Buffett, also known as the Oracle of Omaha, likes to keep things simple and effective. He's a big fan of index funds, famously saying that a low-cost index fund is the most sensible equity investment for the great majority of investors. This piece of advice is pure gold, especially in today's world where we're bombarded with endless ETF options. Buffett warns us not to get too carried away. It's easy to fall into the trap of thinking more is better, chasing after every. Why is it the case? Whenever you make changes to your investments, you may incur expenses and taxes that reduce your returns. Additionally, you risk missing out on reliable growth-oriented companies by becoming sidetracked by the newest, trendiest investment. Buffett's investment philosophy is based on the long term, so our goal should be to purchase companies that we would be content to own forever. He once stated, "Our favorite holding period is forever," which serves as a reminder that choosing your investments carefully and sticking with them can really pay off. This goes beyond simply avoiding the inconvenience and expenses of frequent trading. Giving your investments the opportunity to grow and compound over time is important. Additionally, it's important to remember that Buffett has long been wary of complex investment strategies that promise extremely high returns. He frequently makes the point that these strategies not only fall short of beating the market over time, but also unnecessarily complicate and increase the risk in your portfolio. Buffett's advice is to keep things simple by building a diversified portfolio of inexpensive index funds or exchange-traded funds, ETFs, that track the overall market. Most investors can probably best follow this route, as it allows them to benefit from the market's growth without getting sucked into the commotion. All right, let's get right to the point of this discussion. The big no-no in investing that Warren Buffett is constantly warning us about. You've probably heard the term diversification thrown around a lot. It's a risk management strategy that combines a variety of investments within a portfolio. The idea behind this approach is to spread your investments across a variety of financial instruments in order to avoid putting all of your eggs in one basket. Sectors and other subcategories, this is where it gets interesting. The idea is to minimize the impact of a single negative event on the overall performance of the portfolio. Buffett informs us that diversifying too much, particularly with ETFs, may not always be the best option. Yes, you heard correctly. You can have too much of a good thing. We reasoned that it was because all they would be doing is owning a portion of America, and they decided that only a portion of America was valuable. I don't disagree with that at all. That is the proper course of action, unless they wanted to up the stakes and begin assessing businesses. But once you're in the evaluation business, that's another story. Diversification is a terrible mistake, in my opinion, especially for those who know what they're doing. If you decide to put in the effort, intensity, and time necessary to complete the task at hand, then Buffett has been fairly clear in his statement that diversification is a safeguard against ignorance. He's not advocating that we put all of our money in one basket, but rather encouraging us to find the sweet spot, a place where there is enough diversity to spread risk without diluting potential gains or making it difficult to track our investments. How can we strike this balance with our ETF investments while adhering to sound advice? Prioritize quality over quantity first. Investing in a few well-selected ETFs that track broad market indices or industries you support is preferable. Instead of distributing your funds among numerous choices, Buffett is a great supporter of exchange-traded funds, ETFs, that track large market indexes such as the S&P 500. One excellent example is Vanguard's S&P 500 ETF, or VOO. It simply covers the entire market and follows Buffett's recommendation that most investors should regularly purchase an S&P 500 low-cost index fund. We never buy something with a price, but here's another Buffett treasure for you. It's far better to acquire a beautiful firm at a fair price than a fair company at a fabulous price. Keeping target in mind, we never buy something for 30 and say, we'll sell it at 40, 50, 60, or 70. We simply don't operate that way, any more than we do when we pay $25 million to acquire a private company like See's Candy. We don't say to ourselves that if we were ever to receive an offer of $50 million for this business, we would sell it because that's simply not how businesses should be looked at. Instead, we ask ourselves if the business will continue to generate more and more money over time. And if the answer is yes, we choose a few strong candidates who will give you exposure to the whole market, such as Vanguard's Total Stock Market ETF or Vanguard Value ETF, and we'll stick with them for the long haul. As Buffett says, investing is a marathon, not a sprint. By keeping things simple and concentrating on quality, you're positioning yourself for long-term success. To further enhance our comprehension of Buffett's advice on ETF investing, let's add some historical context and trends. The doom bubble of the late 1990s and early 2000s is a prime example. Investors at the time were wildly over-diversifying into tech equities and tech-focused exchange-traded funds, ETFs, rushing after the newest internet startups with little consideration for their profitability or underlying worth. Buffett avoided the madness, according to his beliefs that he should only invest in businesses with strong foundations. When the bubble burst, investors who had dispersed their money too widely among these hip tech ETFs incurred large losses. The recent rise in thematic exchange-traded funds, ETFs, that concentrate on particular niches, such as blockchain technology, renewable energy, or electric vehicles, is a noteworthy trend. While these can provide exposure to emerging industries with high growth potential, they also represent an example of over-diversification. Buffett's disciplined approach protected his portfolio from the worst of the downturn, purchasing an excessive number of these niche exchange-traded funds, ETFs, might result in a dispersed portfolio that is more susceptible to market fluctuations and less likely to see steady long-term development, according to Buffett. Buffett's personal investment in the S&P 500 through Vanguard's S&P 500 ETF, or VOO, demonstrates his faith in the efficacy of simplicity and the broad market's potential for long-term growth. This exchange-traded fund, ETF, provides access to top companies across various industries. It adheres to Buffett's recommendation to invest in the future performance of the U.S. economy rather than selecting individual winners. Now that the most anticipated questions have been addressed, let's examine these figures and determine the potential returns on your ETF investments. Consider that you had an ETF tracking a significant index, such as the S&P 500, representing a portion of the market in your portfolio. After accounting for inflation, the stock market has historically returned between 7 and 10% annually on average. But how does it translate to real earnings through ETFs? Let's imagine you put $1,000 initially in a Vanguard ETF and want to add $100 per month based on an 8% average annual return. With the power of compounding, your investment would grow to over $59,000 after 20 years. This includes your initial $25,000 donation of $1,000 plus an additional $100 every month for 20 years, expanding by over $34,000 simply from returns. Let's now discuss dividends. Many exchange-traded funds, ETFs, offer dividends that you may choose to reinvest, which will further fuel the development of your investment through compound growth. It's like getting a bonus that keeps on giving because the dividends you reinvest are used to purchase further ETF shares. This could therefore result in higher dividends. However, no investment is risk-free, and previous success does not guarantee future outcomes. The arithmetic behind ETFs demonstrates that you might perhaps accumulate a sizable nest egg given time, patience, and a disciplined strategy. Reinvesting dividends and starting early are crucial, so don't forget to make regular contributions. Buffett's long-term investment philosophy and his faith in the compounding effect are in line with this strategy, which focuses on inexpensive exchange-traded funds, ETFs, that provide exposure to the whole market. We've covered a lot of territory, from comprehending the allure of ETFs to deciphering the arithmetic that demonstrates their potential to handling the typical blunders to avoid. So you're positioning yourself for a shot at steady returns over the long term. However, we want to hear from you on two things. First, how you intend to implement Buffett's advice on striking the appropriate balance in your ETF investments. And second, if you have ever fallen into the trap of over-diversification, what effect it had on your investment journey. Please feel free to share your ideas, questions, and answers in the comments section below. Your contributions not only benefit our community, but also advance our collective investing knowledge. In conclusion, while Vanguard ETFs offer a convenient and cost-effective way to invest in a diverse range of assets, it's crucial to heed Warren Buffett's advice and avoid the mistake of blindly following popular trends. Instead, take the time to understand the underlying fundamentals of the ETFs you're considering and ensure they align with your long-term investment goals. By doing so, you'll be better equipped to make informed decisions that can ultimately lead to greater financial success. If you found this video helpful, don't forget to like, share, and subscribe to our channel for more investing tutorials and valuable insights. Thank you for watching.